Welcome to StokTok's deep dive into Texas Instruments. Texas Instruments designs and manufactures analog and embedded processing semiconductors used across industrial, automotive, and consumer electronics applications worldwide. At the time of recording, the stock is trading at 229.82, sitting near the top of its 52-week range of 142.64 to 200. And 31.32. The 50-day moving average stands at 206.63, well above the 200-day moving average of 189, signaling strong intermediate-term momentum. However, the 14-day RSI, a measure of price momentum on a scale of 0 to 100, reads 74.2, which places the stock in technically overbought territory. The structural setup warrants attention. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Texas Instruments earns the majority of its revenue from analog semiconductors, chips that process real-world signals like temperature, pressure, and sound, alongside embedded processors. Its competitive moat lies in an enormous catalog of tens of thousands of products, deep customer design cycles that create meaningful switching costs, and a vertically integrated manufacturing base that management has deliberately expanded. The StokTok score for Texas Instruments is 51 out of 100, signaling a hold. Profitability scores 18 out of 20, and financial health scores 14 out of 20, both strong. Valuation scores 10 out of 20, growth scores just 1 out of 20, and smart money scores 8 out of 20. A business of genuine quality, operating in a challenging near-term growth environment. Now, valuation. The question every investor has to answer: are you paying the right price? At the time of recording, Texas Instruments carries a trailing price-to-earnings ratio, the price you pay per dollar of current earnings, of 42.25 times. That is a meaningful premium for a company with negative near-term revenue growth. The forward price-to-earnings ratio, based on next year's estimated earnings, comes down to 35.56 times, which implies the street expects a meaningful earnings recovery. The enterprise value to EBITDA multiple, a measure of total company value relative to operating cash generation, stands at 26.47 times. Peers in the analog semiconductor space, such as analog devices and microchip technology, have historically traded in the teens to low 20s on this metric, so Texas Instruments is commanding a notable premium by that comparison, in our view. On economic moat, the data suggests Texas Instruments benefits from deep switching costs. Once a customer designs a Texas Instruments chip into a product, re-engineering is expensive and time-consuming, alongside scale advantages in manufacturing. GuruFocus Value, an independent intrinsic value estimate, stands at 191.35 at the time of recording, implying the stock is trading at a premium of roughly 20% to that estimate, a negative margin of safety. Wall Street analysts, at the time of recording, have a consensus mean target of 225 across 32 analysts, with a high target of 270 and a low of 160. The next earnings report is due April 22nd of next year, with the street expecting earnings per share of approximately 1.38, a near-term catalyst worth monitoring closely. Market sentiment around Texas Instruments, as of the creation of this video, leans bullish, with a prominent hedge fund actively accumulating shares and analyst commentary suggesting the potential for a multi-year breakout. In our view, the valuation is stretched on most conventional metrics, though the quality of the business and improving sentiment offer partial justification. Moving to financial strength, how solid is the foundation? The Piotroski F-score, a 9-point checklist of profitability, leverage, and operating efficiency signals, comes in at 6 out of 9 for Texas Instruments. A score in the 6 to 7 range is generally considered healthy, indicating the company is passing more financial quality tests than it is failing. The Altman Z score, a multi-factor model used to assess bankruptcy risk, where scores above 3 are considered safe, registers at 10.45. That is a very strong reading, suggesting no meaningful near-term financial distress risk whatsoever. Turning to the debt picture, the cash-to-debt ratio is 0.35, meaning Texas Instruments holds 35 cents of cash for every dollar of debt, a moderate coverage position. However, interest coverage, the number of times operating earnings can cover interest expense, stands at 11.31 times, which is a comfortable buffer by any institutional credit standard. The current ratio, current assets divided by current liabilities, a measure of short-term liquidity, is 4.35, which is exceptionally strong. Debt to equity is 0.86, a manageable level for an asset-intensive semiconductor manufacturer. In our view, the balance sheet is well constructed, with liquidity providing meaningful resilience even through a prolonged revenue down cycle. Next up, profitability. Is this business actually making money efficiently? We start with return on invested capital, which measures how effectively the company generates returns from the total capital it has deployed across the business, at 19.56%. For context, most institutional frameworks treat a sustained return on invested capital above 15% as a hallmark of a genuinely high-quality business. Texas Instruments clears that bar with room to spare, in our view. The gross margin, revenue remaining after direct production costs, is 57%, reflecting the pricing power embedded in the company's proprietary analog chip catalog. Moving down the income statement, the operating margin is 34.73%, which is exceptional for a capital-intensive manufacturer and speaks to the operational leverage in the business model. Net margin, the percentage of revenue that becomes profit after all costs including taxes and interest, is 28.28%. That is a world-class figure in any sector, not just semiconductors. Free cash flow margin, the percentage of revenue converting to actual cash after capital expenditures, is 14.72%. It is worth noting that this figure has compressed as the company executes a multi-year capital expenditure program to expand domestic manufacturing capacity. The profitability score of 18 out of 20 in our framework reflects this genuinely outstanding earnings quality. The data suggests Texas Instruments is one of the more efficient businesses in the entire semiconductor landscape. Onto growth, is this business expanding, and at what rate? This is where the picture becomes more complicated, and frankly where the bear case rests most heavily. Over the trailing 3 years, Texas Instruments has posted revenue growth of negative 4.1%, meaning the top line has actually contracted on a compounded basis over that period. Over the trailing 5 years, revenue growth recovers to a modest positive 1.6% annually. These figures reflect the semiconductor industry's well-documented inventory correction cycle, where end customers over-ordered during the supply shortage era and are now working through excess stock. Texas Instruments, with its heavy exposure to industrial and automotive end markets, has felt that correction acutely. Book value per share growth, a measure of the net asset value being accumulated per share over time, has been 3.7% over the trailing 3 years, which is modest but positive, suggesting the balance sheet is not deteriorating despite the top-line pressure. On dividends, the company currently pays a yield of 2.42%, which is meaningful for a technology name, and reflects a long track record of dividend growth that management has consistently maintained even through downturns. The growth score of just 1 out of 20 in our framework is a direct reflection of the revenue contraction. We would want to see a clear inflection in industrial and automotive demand before re-rating the growth dimension. The setup for a cyclical recovery is plausible, but the data has not yet confirmed it at the time of recording. Now let's talk smart money. What institutional capital is actually doing with this name? 24 top-tier investment managers tracked by our framework currently hold positions in Texas Instruments. Among the most notable, Torrey Funds has the company at 3.73% of its portfolio and has been actively adding, increasing the position by 22.56% recently. Christopher Davis of Davis Advisors, a manager with a long reputation for disciplined quality investing, holds the stock at 2.22% of portfolio and has also been adding, up 23.12%. David Katz of Matrix Asset Advisors has been the most aggressive buyer in this group, adding 30.84% to the position, with Texas Instruments representing 2.09% of that portfolio. Terry Smith of Fundsmith, one of the most followed long-only managers globally, holds the name at 2.66% of his portfolio, but has been a modest reducer, trimming 3.61%. Wallace Weitz of Weitz Investment Management holds a 1.7% weighting and has essentially maintained the position. On the broader institutional picture, only 12.2% of 13F filers, the mandatory institutional ownership disclosures filed with regulators, are net buyers, which is below the 50% threshold we would consider broadly bullish. Insider ownership stands at just 0.53%, which is low, and over the most recent 3 months on record, insiders have filed 7 sell transactions and 0 buy transactions. That insider selling pattern warrants caution, in our opinion, and is a meaningful component of the smart money score of 8 out of 20. And finally, the verdict. Let's bring it all together. On valuation, in our view, the stock is trading at a stretched premium. The trailing price-to-earnings ratio of 42.25 times and a negative margin of safety relative to GuruFocus Value suggest investors are pricing in a recovery that has not yet materialized in the numbers. On financial strength, the balance sheet is genuinely solid. An Altman Z score of 10.45 and interest coverage of 11.31 times give the company significant runway to navigate a prolonged down cycle without distress. On profitability, Texas Instruments is a best-in-class operator, and return on invested capital of nearly 20% and operating margins approaching 35% reflect a durable, competitively advantaged business. On growth, this is the most pressing concern: negative revenue growth over the trailing 3 years, and a growth score of 1 out of 20 suggest the cyclical recovery thesis is not yet confirmed by the data, and we would want to see it before underwriting a full re-rating. On smart money, the picture is mixed. Select quality managers are adding meaningfully, but broad institutional participation is thin, and insider selling adds a note of caution. The overall StokTok score of 51 out of 100 reflects a hold, a business of genuine quality in our view, but one where the current price appears to demand near perfection in the recovery scenario. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Texas Instruments. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.